Ladies and gentlemen, I introduce to you the likely next Jerome Powell, Fed chair. This is Kevin Hassett, who is currently the director of the National Economic Council of the United States and is currently expected to be, by the market, Trump's pick for the next Fed chair. Taking a look at Polymarket, this is where I'm getting this information from, which the betting market is historically very good at predicting things. We see that Polymarket says to who will Trump nominate as Fed chair with a pretty sharp expectation at being 75% Kevin Hassett. Now, as a backup, we have Kevin Warsh, Christopher Waller, and Rick Reeder as the other contenders, but it seems very likely that the next Fed chair or selection from Trump is going to be Kevin Hassett. The natural next question is, what does this mean and what is Kevin Hassett all about? Well, here's a little preview. I think that part of the reason the dollar has slid here a little bit and stocks have been on the rise, unlike Jerome Powell, who has been a lot more cautious to lower interest rates, it's expected that if Kevin Hassett is put in the chair, we are going to see some rate cuts. So let's talk about the Kevin Hassett playbook and why Donald Trump might be choosing him as the next Fed chair. And with this in mind, let me just disclaim, this is the Republican theory. It is not necessarily exactly how things will go, but it is at least what we as traders should be looking at in terms of the mindset of the current administration. Kevin Hassett's playbook is probably in line with the Republican mantra that less taxes and lower interest rates can lead to economic booms, a traditional sort of Ronald Reagan type thinking. The idea is that the lost tax revenue is made up by more economic activity to tax in the first place. By booming the economy, there's simply more activity for the government to take advantage of, even if it's at a lower tax rate. The idea or theory is that more revenue will be generated for the government to ultimately use. Another mantra of the Republican Party is to, at least in theory, not so much necessarily in the Trump administration, one of his critics, or one of the many things some Republicans criticize about the Trump administration is that smaller government doesn't necessarily seem to be a priority, but we'll see. And finally, lower interest rates make homes more affordable for the masses. So the idea of the Fed chair, Kevin Hassett, if he takes the role, is likely to be lowering interest rates to kind of administer that economic activity and homes more affordable. Now, let me be very clear. With every theory in economics, government, politics, etc., there are counter theories. That's why this stuff is controversial. Critics of this would say that cutting interest rates and an economic boom disproportionately favors the wealthy class, making asset prices like homes actually explode to even more unaffordable rates. And the theory that cutting interest rates and lowering taxes spurs economic growth is probably true. The question is, does the economy grow enough to grow the added national debt that will almost certainly come with it? Regardless, for traders, what does this mean for you and I? Well, this likely is a bearish catalyst for the US dollar. However, I'm not willing to just say I think the dollar is going to plummet lower on this. A more dovish Fed chair is likely to be a softer thing for the US dollar, as more rate cuts could send the dollar lower. And from a stock market perspective, I would say this is bullish. Lowering interest rates and printing of money is something that the stock market just historically absolutely loves. So for now, I think that the stock market party can carry on, even if it feels a little unfair for lower end consumers who are not feeling the same love and things are very expensive. I think that it can continue to bolster stock market prices higher into 2026, and it is part of the reason I remain bullish going into next year. Lower interest rates are good for consumers to an extent, makes things more affordable, and it also bolsters economic activity. Even if it comes at the cost of higher national debt, at least in the here and now, it's a ton more spending that floods into stocks and things like that. Gold is also moving higher here recently. I think this is part of the idea of lower interest rates and higher national debts make gold look also very attractive going into next year. I remain bullish on gold from a tactical perspective and from a technical one as well. Gold continues to get a strong reading on the Edge Finder with a +6 reading favoring technicals and economic conditions, which again I think favor rate cuts, which is bullish for precious metals. Remember, rate cuts are essentially flooding money into the system, and more fiat currency being printed is bullish for precious metals. At the same time, we're getting some interesting readings on the Russell 2000, a very sensitive to interest rate stock market index. So we'll see what that comes out to, but +9 score, technicals look good, sentiment looks good, and economic data looks good. I really like that reading as well. We're actually getting some dollar bearish readings within the Edge Finder as well, with Kiwi dollar and Euro dollar getting bullish ratings here within Edge Finder at this time, +8 and +6 scores accordingly. Now, when I get a reading like this, what I then do is I go check the charts and see if there's a setup that aligns in favor with what the Edge Finder is finding. And that's how I find most of my trades. This is my watch list, and then I go check the charts to see if there's a setup for me. The Edge Finder is looking at sentiment, technical, and economic data for me so that I don't have to stare at that stuff all day long. And today we've got the big guns coming out. Our Cyber Monday deal just dropped, and the Edge Finder is on super sale. Today only, you can save $560 on the Edge Finder, and if you need a payment plan, you can also set that up. We're doing 45% off if you message us down below using the first link in the description of this video. I'll also leave it as a pinned comment if that's easier for you, or you can scan the QR code that you see on your screen right now to chat with a support representative here at A1 Trading. Don't miss our Cyber Monday deal. It is our best deal of the year. And stocks are really strong here right now. Take a look at today's price action, down a little bit. We were down a little bit more earlier, but so far I still think that this just all looks constructive for an end of year rally in the S&P 500, NASDAQ, etc. Interestingly, I mentioned the Russell also. I'd be really interested in two potential setups, either a dip back to this 2400, 2375 region, this kind of area of support looking left. If we come into that area, I think we look constructive, or a break through the all-time highs also looks really good for Russell. I think from a big picture, rate cuts coming down the pipeline are probably going to be good for the Russell, as smaller cap companies are more sensitive to borrowing rates. The S&P 500 also had one of its best Thanksgiving weeks in decades, and we just pretty much shot straight up from the lows, following through almost all week long. Now Monday, we're getting a little bit of more volume coming back to the desk and a little bit of selling, but nothing too aggressive, at least at the time of recording this. From a weekly chart perspective, we did ultimately hold very nicely this previous level of support right around this 65.10 level. And I do think that if the trend continues to prevail, we are likely headed through those all-time highs to new fresh highs. And by end of year, I've mentioned this, I don't think that this would be out of the question to see a push up to 7,000 on the SPX. With a move of just about 1.5% away to get back to all-time highs, and for 7,000, you're talking about under 3%, I think it's very doable and that we could see a good rally in December. And part of the reason I think we could actually see 7,000 by end of year is because most traders do not think we can. We're looking at the AAII Investor Sentiment Survey, and you can see that bearishness is out of control recently. Pretty much all year long, we have had high levels of bearishness. And what's interesting is that this has actually been a pretty remarkable recovery year. You had the big down move in April, followed by pretty much a grindy upward trend for the rest of this year. And most traders still are hesitant, cautious, and bearish on this market. In fact, this is probably the most bearish stock market rally that I've ever seen. Very rarely do you get all-time highs being hit many times this year, and at the same time, people are still bearish on it. However, there are some fair reasons that people are feeling this way. Let's talk about that. Inflation is still at 3% and has been pretty sticky for the last few years. The consumer has felt a little bit tired and has spent pretty much all their money. However, the stock market keeps going up anyways. We've also seen a slight uptick in unemployment rate, though it's not dramatic. It still feels pretty high, especially for younger consumers. It's around somewhere in the neighborhood of 10% for like 20 to 30-year-olds. Fact check me on that, but I know it's somewhere in that region. So unemployment rate is higher for people who are just getting out of school. So that does not feel very good. However, there's not all doom and gloom here. Wage growth in terms of an aggregated basis is 3.8%, which does outpace inflation. This is a nice thing, and contrary to like 2022 and 2021 where inflation was running hot, this was not the case. So we are seeing something healthy here for the consumer, which is wages rising just slightly above the rate of prices rising, which is good. And when we look at seasonality for the NASDAQ specifically, we are mostly holding up with historical averages, which is to see a strong period of time during October through December. And you can actually see like mid-October, we really bottomed in this market and have continued to have a little bit of consolidation, but would not be surprised if we end up resolving to the upside if history plays a role here. However, there's something else that we need to talk about, which is Bitcoin completely falling apart. Is this sending off sirens or red flags to the rest of the market, considering Bitcoin is dropping so precipitously, even though historically speaking, it should be going up if history or seasonality were repeating? And this is a bit of a disclaimer: with every indicator under the sun, nothing works all of the time. Seasonality, like anything else, can be historically pretty correct, but miss it sometimes, right? Everything can be right and wrong sometimes. And it's all about probabilities. Let's say that like there's a 60% chance that we saw an up move in this period of time this year for Bitcoin. Well, something came along, and we're going to talk about in a second, that may have derailed that idea and pretty much made this idea obsolete this year. This is why trading is hard. If anything was that predictable, then markets would be easy money. And we know very well, if anybody's been trading for any amount of time, they know trading is hard. It's all a game of probabilities, and managing risk is imperative because, again, if you were all in on Bitcoin because you thought it was going to rally into year's end, this has probably been a troublesome time for you. And full transparency, I had 2 losing trades trying to go long Bitcoin during this time, so I'm not by any means, out of the woods in terms of my thinking being, hey, Bitcoin could have a strong end of year. Perhaps there will be some sort of a resurgence towards the end here in December, but this year so far has been a train wreck for Bitcoin. Today's video is sponsored by Black Bull Markets. Black Bull is a New Zealand FMA regulated broker offering forex, metals, and crypto trading to their users. With access to over 26,000 tradable instruments, everything from gold, commodities, indices, and more, through their CFD platform, you can trade pretty much anything. They're also backed by one of New Zealand's largest investment management firms and provide institutional grade trading conditions. Black Bull Markets has also earned multiple industry awards for their fast execution speeds and their leverage trading opportunities on their platforms. Traders can access up to 1 to 500 leverage and choose from several platforms like MT4, MT5, CTrader, and TradingView. And something super cool is that they offer no commission on crypto trading, as well as highly competitive spreads, especially on Ethereum. And for a limited time, active traders can receive free TradingView Premium and up to $60 reimbursed every month just for trading with Black Bull. And if you're interested in copy trading, they have an expansive platform just for that. You can see real trading results from other traders in a live environment through their copy trading platform. And when it comes to choosing a great brokerage, choosing one with competitive trading costs in the form of spreads and commissions is very, very important. With their ECN Prime option, you can see spreads from 0.1 pips, which is pretty crazy. And of course, if you're a larger trader, this institutional package looks incredibly competitive, with spreads from 0 pips as well as a $4 round turn commission. Of course, there is a minimum deposit on this, but all 3 of these look highly competitive compared to the industry. Make sure to use the link in the description down below. We'll leave all the information you need to start trading with Black Bull and start taking your trading to the next level with their amazing platform, their competitive spreads, as well as their copy trading platform if that's something that you're interested in as well. So like I said, make sure to use the link in the description down below to support my channel and also to check out Black Bull to see if it's a right fit for you. Now back to the video. In fact, as we speak, Bitcoin is down almost 6%. Meanwhile, the stock market is just slightly down today. So let's talk about it. What's really going on with Bitcoin right now? Well, the Bitcoin to gold ratio is showing something very obvious. People are choosing gold over Bitcoin for a very, very strong preference right now. And with a 6% down move after the recovery that took pretty much all week to do, we wiped it out in one day. Is there something wrong here? Well, here is what many people, myself included, would attribute the problem with Bitcoin right now to. It is the Japanese government bond yield for the 10-year. It is skyrocketing here today off of some comments from Governor Ueda, who is part of the Bank of Japan. Now, what is going on with this giant surge, and what does Japan have to do with Bitcoin, you may ask? Well, everything. Markets trade in tandem with one another. They're all sort of interconnected. What's happening in gold impacts Bitcoin. What happens in Bitcoin impacts the NASDAQ. They all sort of communicate. It's sort of like one big party with a bunch of different characters at that party. And Bitcoin is the wild party person. So what does Japanese bond yields rising have to do with Bitcoin? Well, it has to do with the carry trade, which is a relatively straightforward concept. The Bank of Japan offers low interest rates. When a central bank offers low interest rates, it means that you can borrow from that central bank at very low cost. So what many investors and hedge funds and portfolio managers and pension funds globally do is they dramatically borrow from the Bank of Japan. And when you borrow, you essentially sell Japanese yen. Then with that borrowed money, you go out and buy something that offers you a higher yield. To visualize this, I pulled up the interest rate projections tool within Edgefinder. What we can see here is that currently the Bank of Japan is offering a 0.5% interest rate, as opposed to something like the US, which is considering dropping interest rates further, but currently offering 4%. Now, obviously, it doesn't take a rocket scientist to understand that if I borrowed from the Bank of Japan at 0.5%, that's what I owed them, and then I lent it to the US and got 4%, there is a positive spread there. The issue is that that spread can change over time, especially if the Japanese in red here are planning to potentially hike interest rates in coming months or years, which is exactly what the Governor Ueda said or hinted at potentially doing in today's kind of news break. At the same time, we know that the US is considering talking about cutting interest rates. In fact, with Kevin Hassett on the docket, we are likely to see some rate cuts. This combination of Japan hiking rates and the US cutting rates squeezes that effectiveness or the yield offered by selling Japanese yen and buying something like US bonds. So what the heck does that have to do with Bitcoin? Well, remember that if the piggy bank to borrow money cheap is no longer as cheap to do so, many investors may need to unwind that carry trade, which is again that arbitrage where you can kind of sell or borrow yen and then go use it to buy other things, including Bitcoin. That's what investors are now doing the opposite. And so what we see here is Bitcoin is one of the easiest things for investors. Now the hedge fund community is very involved in Bitcoin. They have the ETFs accessible. It's way more accessible to institutions and sovereign communities, all sorts of different things, right? Bitcoin is one of the easiest things for those types of investors to liquidate to raise capital. And so I think that is largely what is taking place right now. Some part of me years ago wanted to believe the story that Bitcoin was some sort of off the grid money that was not impacted by traditional fiat currency stuff. And in reality, although I really like the mission of Bitcoin, I don't think that that's the case at all. I think that Bitcoin very much is essentially a leveraged tech stock. It trades like a risk asset. It follows risk assets. It's sensitive to what's happening with traditional central banks and fiat currency. It's essentially a speculative investment that if you believe in, you can make a lot of money if you're right, or a lot of losses if you're wrong. Personally, I use Bitcoin solely as a trading vehicle. When I feel risk off, I'm generally more bearish on it. When I'm generally more risk on, I'm more bullish on it. Maybe someday something will change structurally with Bitcoin to take it out of the risk on bucket and rather just some sort of digital gold aspect. But I personally don't think that day is today. Now, by no means am I a perma bear or perma bull on Bitcoin. Like I said, I traded it. I trade it all the time. So if it starts trending up and we have a good reason to think risk on could prevail, I'll probably be long again. But for now, I'm not going to go down with the sinking ship, and we'll see how far it goes. Maybe it's going to do another one of its 60-70% drawdowns. Maybe not. Maybe it's going to bottom out and start trending up, in which case I'll happily start to join that uptrend if it starts to take place. And don't forget to take advantage of our Cyber Monday deal for the Edgefinder. It is the biggest discount that we do all year long. I know a lot of people have been waiting for this, so don't miss it. Here's your chance. Pick up some great tools at our best price all year long. Thanks for watching.
Hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.